All right, let's just jump right into it. If you've taken even a peek at the crypto market lately, you've probably felt your stomach drop. After an absolutely dizzying run-up, Bitcoin has decided to give us all a masterclass in gravity. So what on earth just happened? We're going to break it all down.
First things first, let's talk about the big, scary number, negative 50%. From its peak back in October 2025 of around $126,000, Bitcoin's price has been, well, pretty much cut in half. That is a staggering drop that has wiped out an estimated $2.2 trillion from the entire crypto market. This isn't just a little dip, folks. This is a massive, market-wide event.
And this quote, man, it really gets to the heart of the story. You see, this wasn't just any old price drop. This was a breach of a major psychological fortress, the 2021 all-time high, right around $69,000. For years, the market looked at that level as the ultimate floor, the line that would never break. Well, that floor just shattered. So that brings us to the million-dollar, or I guess trillion-dollar question, why? Why is this happening now? Was it one single thing, or was it a perfect storm of a bunch of factors hitting all at once? Well, to really get what's going on, we need to look at what's happening both inside the crypto world and what's happening outside of it. Okay, let's start with the inside job. The first piece of this puzzle is all about the powerful forces churning within the crypto market itself, the things that took a little price dip and turned it into a full-blown avalanche. And the speed of this collapse, wow, it was just breathtaking. In a single 24-hour period, a whopping $1.4 billion was forcibly liquidated from traders. Now, these were people using borrowed money to bet that the price would go up. This right here is how a small dip spirals out of control.
And there's a name for this whole phenomenon. It's called a long squeeze. Think of it like this. A whole bunch of people made a leveraged bet, a bet with borrowed money, that the good times would keep rolling. But when the price dropped suddenly, their brokers automatically sold off their positions to cover the debts. And all of that forced selling, it just pushes the price down even further and faster.
And that's what creates this vicious cycle. Let's just walk through it real quick. First, the price dips just enough to hit a certain trigger point. Boom! That sets off the first wave of automated sell orders from those leveraged traders. All that selling pushes the price down more, which, you guessed it, triggers the next level of sell orders. It's a chain reaction, a domino effect that just feeds on itself and makes the crash accelerate. But here's the thing. That automated selling was only half the story. While all these smaller traders were getting wiped out, the market's biggest players, the ones we call the whales, were making very different and very deliberate moves of their own.
If you look at the on-chain data, you see this absolutely fascinating split. On one side, you have the whales. These are the wallets holding thousands and thousands of Bitcoin. And what were they doing? They were selling. They were de-risking. They were moving huge amounts of Bitcoin onto exchanges, a classic sign they're getting ready to sell. And on the other side, you have the shrimp, the smaller retail investors. And they were doing the exact opposite. They were buying the dip, accumulating more, and holding on to hope.
You know, Alice said this, and it just nails the point perfectly. When a whale moves thousands of Bitcoin from a secure private wallet to a liquid exchange, there's usually only one reason they're doing it. They intend to sell. This was a huge red flag that the smart money was heading for the exits, while the crowd was still hoping for a bounce. Okay, so that was all the pressure building up from inside crypto. But this crash wasn't happening in a bubble. So now, let's zoom out and look at the powerful forces from the outside world, from traditional finance, that were pouring gasoline on this fire. What we're seeing right now across the board is a classic risk-off moment. That basically means investors everywhere are getting nervous. They're pulling their money out of speculative, high-risk assets like crypto and tech stocks and running towards safer bets. This wider financial anxiety created huge problems for Bitcoin, especially in two key areas: the big institutional money flowing through ETFs and some new uncertainty at the U.S. Federal Reserve. For months and months, those new spot Bitcoin ETFs felt like an infinite money glitch, right? Just a constant fire hose of institutional cash flowing in, pushing the price up. Well, that fire hose just got turned off and then put in reverse. On a single day, February 4th, these ETFs saw over $500 million in net outflows. The institutional buying that was propping everything up wasn't just gone. It was now working against the market. And as if that wasn't enough, then came a political wildcard. The nomination of a guy named Kevin Warsh to be the next chair of the Federal Reserve really spooked the markets. Why? Because Warsh is known for wanting a leaner Fed balance sheet. That's a fancy way of saying he wants to tighten monetary policy and make money more expensive.
And that kind of uncertainty is absolute poison for risk assets like Bitcoin.
So you've got the internal liquidations, you've got the external macro fears. What does all this actually look like in the real world? Let's ground this whole thing with a case study of one of the biggest, most outspoken corporate believers in Bitcoin, MicroStrategy.
So this company, which is led by the famous Bitcoin bull Michael Saylor, has made an absolutely enormous bet. As of February, their corporate treasury holds over 713,000 Bitcoin. I mean, it's a massive, all-in kind of position.
But here's the number that really matters. Their average purchase price, their cost basis, for all of that Bitcoin is just over $76,000 per coin. That means for their entire strategy to be profitable, the market price has to stay above that level. And, well, as we've already talked about, the price is nowhere near that level anymore. With Bitcoin trading down in the low to mid 60,000s, their entire massive investment is now, on paper at least, significantly underwater.
And the result? In their latest quarterly report, MicroStrategy had to report a staggering paper loss of, get this, $12.4 billion. It's a brutal example of the real-world financial pain this crash is causing, even for Bitcoin's biggest champions.
So we've looked at the internal mechanics, we've looked at the external pressures, and we've looked at a real-world example. It all leads us to the one big question that's on everybody's mind. Are we heading into a new, long, cold crypto winter?
And just so we're all on the same page, a crypto winter isn't just a quick dip. We're talking about a long, painful, grinding period of low prices, low interest, and just a general lack of enthusiasm. The speed and the sheer brutality of this crash have analysts seriously debating whether we're standing at the beginning of one right now. So what happens next? Well, as you can imagine, analysts are completely split. The bears out there think the price is going to keep sliding, maybe down toward that next key support level around $55,000. If that level breaks, it pretty much confirms a new bear market. The bulls, on the other hand, they're arguing that this is a classic shakeout and a great buying opportunity. But even they agree on one thing. For the bull case to have any life, Bitcoin absolutely has to fight its way back above that critical $69,000 level and hold it.
One analyst, who's looking at historical patterns, even laid out a potential roadmap for the rest of the year. It suggests we could see this sharp weakness continue through February, maybe get a little relief rally in March, before more weakness comes back in the spring. And in this particular scenario, the real final market bottom might not even show up until all the way in October of 2026.
So, is this just a temporary storm or is the entire climate changing? While nobody knows for sure, the weight of the evidence, from the internal leverage and the whales to the external ETFs and the Fed, has really shifted the whole narrative. What seems clear is that the easy money days are over, and the market might just be settling in for a long, cold season.